Hi, welcome to Bond Bytes, a daily bond market highlights from Myanmar bonds. I'm Arjun Patsarthi, and today's market, pretty flat market, with Gsec is marginally down, the rupee slightly up, and Sensex and Nifty fall as derivatives contracts expire for the month of October. Going into the festive season and Diwali week, we'll have to see how the market starts to behave on the equity front. As far as corporate bond goes, there is a good amount of demand seen for state government guaranteed bonds, especially UP Power Corporation bonds in the retail bond market. Retail investors, including provident funds, smaller provident funds, want to invest in bonds that offer a reasonably good level of returns given very low interest rates in their other investments. And they do see UP Power Corporation bonds being a state government guaranteed. The UP Power Corporation bonds is guaranteed by the state and though the company itself, the UP, all companies, including the Rajasthan Power Company that is also traded, uh, they're all run into deep losses at all points of time because very simply put, they sell power to the consumer at lower rates than the cost of procurement, and they're supposed to be subsidized by the state because states don't have the political will to raise power rates. And given next year is the election time in UP, then there will definitely be no power price increase. And this will lead to deeper losses, especially as input costs for power companies are going up sharply due to rising coal prices. So UP Power is always looking to borrow. And when bonds come up for maturity, they depend on the state government to either to repay the investors or they have to raise fresh loans to repay the investors. Mostly the state government tells them to raise fresh loans to repay the investors. And there is always a risk that state governments do not honor their guarantee, though for the UP Power, this has never happened. And there is a good amount of uh, positive factors that investors see the UP. It was a reasonably government in reasonably good financial shape till the COVID hit. And but the government itself, all state governments are now being supported by the government, central government, and the RBI through overdrafts. And RBI is also helping state governments by buying state government loans, SDLs, which they never did earlier. Apart from buying government bonds, RBI is also protecting state government bond yields from rising too fast by buying state government bonds. And so the market perception is that RBI will always support state governments, and state governments in turn will support the state government guaranteed utilities. Now we saw this earlier in this last decade that Uday bonds, when states were all the state electricity boards were in deep losses, and all bank funding was exhausted because banks refused to fund them, and when they had deep losses, then it reached a point of time when the government had to step in, and they issued something called Uday bonds, which was bonds that were specifically designed to replace the deep losses loans of the state electricity boards. So this helped banks to recover some of their loans, and they sold it in the market. And all these bonds were again guaranteed by state governments. So state governments, apart from their deep fiscal mess because of various subsidy schemes and other politically schemes for getting more political mileage, there is they continue to see a huge amount of debt burden increasing, and it remains to be seen where this will all stop. So as far as investors are concerned in state government guaranteed bonds, as long as investors' perception of the state paying back the loans of the utility is good, then they'll continue to buy the bonds. But having said that, there are many people and the institutions who do not really get into these bonds. So there's both a risk and reward in these bonds, and you have to be aware of the risk and reward. And obviously, INR bonds is the best place to come to see what kind of risk anybody takes in buying a state government guaranteed bond. We provide the knowledge as well for how to look at state government guaranteed bonds. Do not forget to come to our webinar tomorrow, 3 p.m. Few slots are available. Largely, we talk about bond laddering, and as we all know from yesterday's bond bites, that repo rates are indicated to go up sharply, largely by the 5-year swap rate. And how does an investor position for repo rates, um, where they can take advantage of rising interest rates as well as protecting themselves against the rising rates? So investors and financial advisors will learn everything about how to build ladder portfolios to suit their investment and earn higher returns, lowering the risk and managing interest rate risk, credit risk, and liquidity risk. The link to participate in the webinar is in the description below. Please click on the link to attend. And all participants will get a free access to our digital retail bond platform, Quick Invest, which also provides bond ladder portfolios for financial advisors and investors to build portfolios, and also provides a whole host of information, transparency, education, and also the ease of investment, where portfolios can be invested through Quick Invest itself. Thank you very much for listening in.